When you're starting out with trading and investing, there are so many things you need to take into consideration. More often than not, investors end up making a few beginner mistakes that end up costing them a lot. Here are the top 5 beginner mistakes that you don't want to make. Don't walk in blind. This may seem quite obvious, but quite a lot of people make this mistake. You really don't want to walk blindly into a trade. Think of it this way. If you were to have a test at school or a job interview, you wouldn't just walk in unprepared, right? You'd do some research and ensure you know all the necessary information before you head for the test or interview. Investing in stocks works the same way. You need to do adequate research before you decide to invest in any stock. As a beginner, you probably won't know much about market trends, trading patterns, or the timings for different data releases. All this information is extremely useful when looking for the best stocks to invest in. Don't let the urgency to trade tempt you into investing in stock without doing your homework. Trust us, you may end up regretting that decision later on. Other than market trends, also make sure you do enough research on the company you're investing in. Check to see their performance on the stock market over time. Also, see if you can find reviews and opinions from other investors. Speaking of reviews and opinions from other investors, don't just blindly rely on these tips. You may even find such investment tips on television shows and on different websites. But you really need to be cautious before you decide to invest your money. It doesn't matter how much of a killer deal it may seem like, or how much money your friends or family have invested in the stock. You need to take multiple things into account. We're not saying you don't take these tips into consideration at all, but that you do your own research as well. It's best that you do your own homework before you decide to pour in your money. It's your hard-earned money. It would be a waste if you lost it just because you were a little impatient. Don't put all your eggs in one basket. As you're still new to selling and trading stocks, it might be a good idea to diversify your investments. You don't want to pour all your savings into a single stock. By spreading your investments out a little, you can lower the probability of losing your money. It helps protect you from volatile stocks and from cases where there are extreme price movements. In terms of long-term performance, research shows that low-cost index funds perform better than 65% to 75% of actively managed funds. Also, keep in mind that as tempting as bigger investments may seem, they're not worth the risk. You don't want to start off by biting more than you can chew. It's best to start small. Think around 100 shares or even less, and then slowly get bigger as your experience and knowledge grow. When investing, you need to make sure you're also prepared to cushion yourself in case of volatility or major losses. This is why it's better to diversify your investments a little. We're not saying you put your hands in more stocks than you can manage, but be smart about your investments. Invest in such a way that if you suffer losses from a certain stock, you have some backup trades to keep you afloat. Don't chase after performance. A lot of time, investors get fooled into thinking a stock is worth investing in just because its current performance seems promising. We said this before and we'll say it again. You need to do thorough research before you decide to invest anywhere. Simply looking at the current performance won't help you judge the nature of the overall performance of a stock. You will need to look at the past trends of the stock and possible future predictions. Has the stock been volatile in the past? Have there been any major drops or rises in the stock prices? How many people have invested in it, and what do they have to say about it? The key is to identify trends and to predict whether investing in the stock will be beneficial or not. For instance, if an asset class has done really well in the past 3 or 4 years, it might not be worth investing in now. This is because the high performance cycle may be at its end. It might help to compare the trends of different stocks, as it will help you understand where you should be investing and what types of stocks you should be avoiding. Another thing that we've mentioned earlier but will reiterate is that as a beginner you cannot blindly follow the herd. By doing this, you will end up either paying too high a price for a hot, rising stock or may invest in a stock that is on the verge of turning over. The more research you do, the more you'll learn about when's the right time to invest in a stock and when it's wise to pull out your investment. Don't ignore important signs and tips. Keep your eyes open for any signs and tips. As a newbie, you need to keep a close eye on how the stock is moving forward. One of the most important things to remember is to constantly keep checking your risk tolerance. Like, for some investors, even a slight up or down in the stock market can throw them off guard. For investors who have a lower tolerance for volatility, blue chip stocks of established firms are a good place to start investing in. We can say with certainty that volatile startups are not a good choice for investors that can't handle ups and downs. While all investments come with certain levels of risk, as a newbie, it's best to start small with the least possible amount of risk. Plus, you need to learn how to act quickly and wisely if you suspect you've invested in a stock that may be moving down. You need to learn how to handle small losses and quickly be able to transfer them into newer, more promising trades. Don't hold on to a losing place in hopes that it may rise up again. You need to act quickly and wisely if you want to save yourself from major losses. Another thing to keep in mind while investing is your time horizon, or the period over which you're saving for. This could be the time when your retirement starts or the time you need to pay for your house. Investments made to save up to buy a house can range from small to medium-term time frame, while financing a college education can have a longer investment time frame. Depending on this time frame, you can think about stock performance. For instance, if you're saving up for your child's education or for your retirement, you won't have to worry about how a certain stock acts in the next 2 years. Don't underestimate or overestimate your abilities. You need to find that perfect middle group, which will help you keep afloat amidst all the volatility in the investment market. You can't underestimate or overestimate your abilities. Being too confident when investing in a stock can be harmful for you, especially if you haven't properly looked into the stock and current market trends. That being said, you also can't always hesitate and hold back. Don't think that only professional investors have a chance of hitting gold. With the proper research and guidelines, even beginners can accomplish a lot. Your commission-based mutual fund salesman may tell you to leave the decision-making to the experts. But we firmly believe that once you're equipped to control your own portfolio and can make your investment decisions, you'll be able to make quite a lot of profitable investments. Honestly, it all boils down to properly understanding the way the investment works, and then using that information to determine whether investing in a specific fund will be beneficial or not. The good news is that these days you can find multiple sources online and offline that can help you get a better grasp of how trading and selling of stocks works. These resources will help you identify the various signs and tips you need to know to make the most of your investments. We would also advise looking into the various graphs and charts that are used to help study the various market trends. The graphs may seem daunting at first, but trust us, they're worth learning about. Because once you read each chart, you will be able to identify future price trends and make investment decisions on your own. It may seem a bit scary and risky at first, but you have to get your feet a little wet if you want to test the temperature of the water. As beginners, researching market trends and on the performance of various stocks is essential. It will take some trial and error, which is why it's best to start with smaller investments as you learn more about the market. You can slowly make bigger investments as you gain more experience. Are there any trading mistakes that you made as a beginner and would want to advise others on how to avoid them? Let us know in the comments below.